Chapter 5, Reinforce Your Wealth. In Chapter 4, I talked about what personal or health events and changes can devastate and decimate your life savings and affect the quality of your retirement years. Now let's look at the external changes that can also reduce your nest egg and that you can protect against. The world didn't see what affects the March 2000 dot-com crash, the following year's 9/11 attack, and immediate market disruptions, or the 2020 COVID-19 pandemic would have on our savings and earning power. Before COVID, and even during its first year, no one saw any inflation. It wasn't on anyone's radar. Before any of these sudden external events, you could have had a plush portfolio going. You could have grown your initial savings into a ton of money. Then bam, your portfolio value plummets 50%. Don't roll your eyes. Don't say, it won't happen to me. It has happened. Look at the stock exchange charts. Market risk and inflation risk are two types of risk that can affect your retirement lifestyle. Banks are good at scaring people about market risks, but as I've said elsewhere, they are not very good about talking about inflation risk. If all your money in the markets goes down the tube in a market crash, you could well outlive your money. If inflation persists and eats away at your purchasing power, you'll need to spend more dollars for the same lifestyle, and again, you might just outlive your money. At age 55, with a retirement goal of 60, you don't have time to watch markets rise again to bring your accounts back to their earlier high amounts. During retirement, you have zero time to recoup losses. You need that money coming in every month. Liquidity risk is also a consideration. As an example, if your money is locked up in 4 or 5 year GICs, or guaranteed investment certificates, at the bank, what do you do if you need cash out right away? That money is not liquid. You cannot cash them out as they are typically non-redeemable during the term of the GIC. Protect your current nest egg from being whittled away by markets and the economy. Make sure enough of your assets are liquid so you are not forced into taking out a line of credit at age 82 for your long-term care bills. Don't let your hard-earned nest egg dwindle. It is also about structure and protection. Any market portfolio needs regular monitoring for performance, and regular means an annual review at the bare minimum before retirement and quarterly once you are retired. You need to be in the right type of investments, which are also right for your degree of risk tolerance, your age, and your future cash needs. Many bank advisors don't ever go that deep in their discussions with you. Don't assume your non-bank financial advisor will proactively bring up this range of topics either, much less that he will even call you to make an appointment. Make the appointment yourself, even if you don't see any particular market changes. The markets are volatile, and you don't want to suffer a down market just when you need that money. Segregated funds. This is a mutual fund with an insurance wrapper. It is sold only by an insurance company. The huge advantage is the initial principal is protected by a death benefit guarantee. The difference between buying a segregated fund and buying a straight mutual fund at your bank is volatility protection. What if, for example, market volatility reduces your fund from the initial $100,000 invested to around $80,000 and you were to pass away? Your bank would only pay out the fair market value of the $80,000 to your beneficiary. However, with a segregated fund, your beneficiary would receive the initial $100,000 that you invested. This solution costs a little more in upfront costs because of a higher management fee, but it is well worth it in a volatile market environment. Another benefit: the money stays out of probate, hence the term segregated or separate from the individual's other assets. In Ontario, the authorities want to know your net worth, and the probate fees will be 15% of that amount. A segregated fund is outside of probate, segregated from your assets, and saves you the fees. Real people, saving thousands in probate fees. I had a family come in to see me in 2021. Patricia, the mother, had been diagnosed with stage 4 lung cancer. Unfortunately, the prognosis was not good, but we had the benefit of some time to ensure that her affairs were in order. Patricia brought her 2 grown children, Jason and Jamie, to the initial appointment. Patricia had over $200,000 in a RIF with her bank, along with over $100,000 in a TFSA and almost $100,000 in a savings account. I suggested that we move the RIF and TFSA funds into a segregated fund and the bulk of the savings into a guaranteed interest account. Patricia named Jamie and Jason as the beneficiaries on the account. Patricia passed away a few months later. Jason called me to thank me because all they had to worry about was paying probate fees on what was Patricia's principal residence. Patricia moved almost $400,000 into segregated funds, and this allowed the money to stay outside of her estate. Not only did Jason and Jamie receive the funds within 2 weeks of Patricia passing away, but they also received $6,000 more collectively because they saved $15 per thousand, or $400,000 times 15% in probate fees. Annuities. These give a predictable, guaranteed income stream. They are insurance products in Canada. They offer payout flexibility to suit your needs. You can have a 10-year term certain and many other payout solutions to choose from. The payout represents a predictable and guaranteed income stream for you. Real people, additional protection, and invisibility. Segregated funds are creditor protected. This can be a great additional advantage. I've had a number of clients who have been sued, life happens, and as we had segregated some funds, they were not affected. No one can take those assets from you. My client Stephanie was diagnosed with terminal brain cancer at a time the markets had gone down, and the segregated fund death benefit topped up funds for her family. Once a will has become probated, anyone can view it as a public document at the city office. Segregated funds will not be visible in such documents. Marilyn was a client in a relationship with an overly controlling spouse. She had a beloved granddaughter to whom she wanted to leave a legacy with no pushback from her spouse. I set up a segregated fund amount with the daughter as the sole beneficiary. Marilyn's spouse didn't know about it, but even if he had, there would be no action he could take to change it. I'm insurance licensed, and I can offer my clients instruments to protect them that they won't be able to get at their bank or other types of financial institutions. Come and consult me about some options. Cash flow security. Could you outlive your money? This is a fear in many people's minds before they pull the trigger and retire. It is why sitting with me is so valuable and a big stress reliever to my clients. I know how to analyze your cash flow. The term cash flow means you have the cash in hand to cover your needs month after month. It means you have assets that are quickly convertible to cash. Convertibility means your shares in your stock portfolio can be turned into cash in one day. Your monthly pension payment comes to you like clockwork as cash. On the other hand, a piece of real estate cannot be turned into cash overnight because of the long process to sell and realize the funds from the sale. Cash flow is an issue to pay attention to throughout your retirement, primarily due to inflation and surprise needs for cash, typically for medical or healthcare issues that arise. Real people, cash flow medical expenses. A client's 70-year-old friend, Stephen, was in the U.S. for a vacation and fell ill there, landing in the local hospital. His money in Canada at his credit union, due to how the credit union set up his account, was not liquid, i.e. not easily accessible as cash. American hospitals want proof of ability to pay for services and care, even from foreign visitors in distress. Stephen had to jump through a bunch of hoops, including applying for a line of credit in the U.S. to pay for his expensive hospital care. Make sure you have money that is accessible. Don't be concerned about the bank's best interests, but your own. Inflation eats away at your cash, so you need to update your plan every year. This means having different pots of money you can take cash from as prices rise over time. This helps maintain your standard of living. Have conservative, protected investments as opposed to lots of money in volatile markets. Inflation is also the primary reason you need to consult with a trusted financial advisor throughout your retirement years about cash flow. Clearly, we do not have a crystal ball to predict how much inflation will affect your nest egg for the next 25 or 30 years. However, we have access to information and calculators to help you prepare for inflation as you move through your retirement. Come and ask me about this. Real people, longevity, and outliving your money. You need to look at your financial preparation to cover long-term health care costs. As an example, if your financial picture allows you to pay for a long-term care facility for 14 years, but you live longer than that, how will your remaining years in the facility be paid? Do you have children who can afford to pay for your costs after the 14 years are up? This is a calculation you need to look at closely. I can help you run the numbers and look at your options. At this writing, I have one client named Dawn who pays about $6,000 a month to reside and receive needed care in his chosen facility. 14 years is just about how long Don's money would last at that level of spending based on his pension and savings. He is disappointed he cannot now afford to pay for a children's education or grandchild's education as he had hoped for because he needs to pay for his own increased costs of living.